Let's bring in Michael Arone. He's a chief investment strategist at State Street Global Advisors on the phone with us this morning. So, Mike, this was not high on many of the strategist lists that we speak with here. Now, suddenly it's on everyone's number one. Does it make sense to you?
Well, it certainly makes sense. It's interesting. At State Street Global Advisors and Spider ETFs, we titled our 2020 market outlook Threading the Needle. And Ollie, essentially what we were doing there is suggesting that after a very solid year and really a very solid decade with very low financial market volatility, valuations elevated, credit spreads really tight, there was, from an investment opportunity perspective, there weren't a lot of those fat pitches out there. And a lot of the kind of margin for error was really small, and many of the risks were skewed to the downside. Now, we couldn't have predicted what's happened from a geopolitical perspective, but what we did suggest to folks was to think about kind of pivoting towards more quality assets, more safer assets, and prepare for some unexpected volatility. And here we are in the first couple of days, and we have some.
So, Michael, you're sort of taking the approach here of kind of the transmission mechanism that, hey, who knew it was going to be something to do with Iran, but the idea was some of the froth maybe needed to shift away from the market.
Our view is that prices had outpaced fundamentals. So if you look at last year, most of the returns, and it was a phenomenal year for investors, were largely driven by investors' willingness to pay higher prices today for better expected future growth and better expected earnings. And our view is just that kind of the prices exceeded or outpaced the underlying fundamentals. And without that improvement in underlying fundamentals, you're likely to see some re-rating of stock prices lower. Now, today we're getting a bit of the geopolitical risk that's resulting in that re-rating. But as you were just talking about on the previous segment, the economic data continues to be sluggish and mixed as well.
So the sluggish and mixed data combined with this new geopolitical risk, Michael, we've got gold taking off. Bonds haven't quite followed yet, but to me that remains a super important relationship, because if bonds are going to go the way of gold, then that doesn't seem like the recipe that has been in place the last 3 months to help cyclicals, to help this kind of reflation trade. If bond yields start dropping again, does that mean the last 3 months is kind of blown out of the water?
No, I don't think so. I think what's interesting is I do think that many of the themes that were evident at the end of 2019 are likely to continue in 2020. So it does seem as though global growth has stabilized some. The other thing is financial conditions certainly are easier than they were at the beginning of 2019. And Ollie, you're talking about this kind of gold bond stock relationship, which I think is important. And what's interesting is if you look at shareholder yield, if you look at cash return basis, S&P is attractive. And what I mean by that is if you consider dividends plus net share buybacks relative to market capitalization, 80% of the companies in the S&P today trade with greater cash returns above 10-year Treasury yields. And the median since the global financial crisis is closer to 35%. So with yields ticking lower, stocks are actually becoming more attractive. And historically, when these events happen, these geopolitical risks happen, for investors willing to take on some risk, it's been a buying opportunity.
So, Michael, to kind of still address this event series the last couple of days, I mean, if you're an investor, if you're a strategist, do you need to, run over to the geopolitical analysis? Do you have to sign up for the newsletters from the Iran experts and stuff? I mean, what will you be looking for from a macro side to see if this turns from a couple-day story into one that really does have weight fundamentally?
I think they'll be looking for a couple different things. Certainly, if the price of oil were to rise significantly. Now, the quick response here hasn't been so much, but if oil were to skyrocket and meaningfully rise here, it could begin to impact global economic growth, earnings, and consumer sentiment. So I think that'll be an important barometer to keep an eye on.
What type of price, Mike, for oil at this point? Sorry to jump in, but what type of price for oil is high now? Because we spent so much time, in the 50s. If we get to 70, is that a problem?
I don't think 70 is a problem. We're nearly there on Brent prices already. I think if you're kind of pushing into that kind of 85 to 90 level, I think that would be a very strong acceleration from where we have been.
Okay.
And I think that'll begin to weigh on consumer sentiment and business sentiment. So I think we have a ways to go there, but in terms of what you were asking, that's something I'm keeping an eye on. And it's in relationship to the consumer, who's been strength for the U.S. economy. So as long as, the markets stay reasonably elevated, we can withstand a correction. Housing prices continue to trend a bit higher. Pending home sales were up last week. Layoffs don't seem to be a problem. So keeping an eye on how gas prices impact consumer sentiment, consumer spending, business sentiment, business confidence will be important moving forward.
Now, right now, still, as we talk about that kind of cyclical theme at the end of 2019, you say to expect more of, just to kind of get some details on how to express that. I mean, is it as kind of core cyclicals like materials and basic commodities like the copper move that we saw, or is it more aligned with banks or the tech stuff that has more of a fundamental kind of cash flow story to it? How do you express that view?
So I think from our perspective, we still continue to favor your kind of more traditional cyclicals like technology, like financials. And then to healthcare, I don't think of as cyclical per se, but I think healthcare is an interesting opportunity in the fact that it sizably outperformed the market return last year, even though it was up. Underlying fundamentals have been improving for healthcare stocks. You have, they were the second cheapest on a valuation basis of the 11 economic sectors. And you have some real structural tailwinds for healthcare. Aging demographic, the continued search to end awful diseases, kind of the continued ongoing care services that folks will need, I think will be important tailwinds. So what's been happening is the political overhang has been a headwind for healthcare in particular. And I think as that becomes a bit more clear as this year plays out, I think healthcare creates an interesting opportunity in something that isn't as cyclical as technology and financials.
Okay, Mike, last point here is the gold bugs and even some of the bond action the last couple of months seem to be this idea that there's kind of a whisper cut that could still be available this year. Are you in line with that theory? Do you think that maybe the Fed is waiting for a reason to cut still?
I think the Fed is likely to remain on hold, but their bias is definitely to cut rates, not raise them. And Powell has said as much. So I do think if we do see any type of Fed action, it's likely to be more easing and not kind of tightening from a perspective, which again should favor risk assets, should favor cyclical companies from that perspective. So I think
Michael,
their bias, and they've said as much, is to ease financial conditions, not to tighten them.
You got it. Fantastic conversation. Michael, appreciate you joining us here this morning. As always, Mr. Arone is the Chief Investment Strategist at State Street Global Advisors.